Are you currently living with just one income and looking to expand your income streams, the amount of income that you're making, and of course, improve and grow your financial wealth? Maybe you're a little bit confused because there's so much out there and you don't even know where to kind of navigate to or who to kind of take some advice from. Because, well, let's face it, investing can be a minefield. Don't worry, this is exactly what this video is for. In this video, I'm going to break down why investing for your future is vital, 5 potential ways and places to invest in, and finally, how much money should you be investing? We're going to cover all of that in this video, so let's get to it. Hey, what's up? It's Peter from the EIR Show, where we talk about everything investing. Be sure to hit the red subscribe button and the notification bell below just to get notified of any new videos that we're going to be coming up with soon. So let's start. Why is investing in your future vital? So let's kind of cover 3, let's say, reasons or targets you'd want to kind of invest for. And the first is precautionary motive, which basically means investing for a rainy day. Right? We all know those days come maybe once in 10 years, it might be once in 5 years, it might be once in 20 years. We don't know, but anything can happen. It could be a death in the family, a sudden tragic accident, or a property that you live in or rent out even needs emergency refurbishment. Either way, one of these days, a rainy day may come. So that'll be one reason as to why you'd want to invest, to cover your rainy days. The second reason you'd want to invest is for a specific purpose, such as retirement, future child education, right? We all know university fees are ridiculous. Or even a parent who, let's face it, might annoy the hell out of you and you need to pay for a nursing home, right? So that's what we kind of cover as a specific purpose. Or it could even be short term, like, a holiday or a new car, but that we'll get into another video. And lastly, the third reason why you should invest, and which I believe is the most important one, is investing to accumulate wealth, which can be later spent on a variety of things, such as a second home or further houses in your portfolios, right? Whatever, we're gonna go down that rabbit hole in a minute. Or a series of holidays or retirement or a child's inheritance, right? Your really kind of long-term down the road kind of goals or investments. Having sufficient funds in your investments could allow you to, take a leave for 6 months out of your workplace if you're working a 9 to 5, if and when necessary. Or even leave your job altogether, which for my situation was definitely the goal. It can also enable you to do things or buy things that, well, you want, or take advantage of an opportunity that may arise. Maybe you know somebody who says, hey, I've got this property for sale and it's going really cheap, or it's an auction or whatever. You get the idea. The list goes on, right? And obviously we can sit here all day long explaining as to what are the benefits to investing. But the bottom line is, why should you invest? The answer is very simple: to create wealth and to, well, future-proof your future, right? So let's move on to the second segment, which is how, right? How do I invest, or what do I invest in? Because let's face it, we can invest in everything from, golden nuggets to oil to stocks to whatever. I'm going to talk through the 5 places or things that I think are worth looking into to invest, right? And I'm choosing my words carefully because this isn't financial advice. If you do want financial advice, seek from somebody that you pay, okay, and that's qualified and credited to do so. But in my experience, and this is what this whole channel is about, in my experience, what I'm doing or what has worked and what I feel I can give solid opinions on. And we're going to start off with number 1, index funds. Now, I love index funds, right? Index funds offer you the ultimate diversification. Index funds are basically a portfolio of certain investments that you buy into and you own a small amount of. Index funds have been a great way to invest. I mean, over the last 100 years or so, we've seen a result of about 7.5% annually, okay? So the proof's in the pudding. And the best thing about it is that there's little to no work, right? They're easy to get into and they have great returns. There are some cons, okay, when it comes to index funds, and that would be, you don't really have a great amount of control and it's not really for the short term. You're looking, if you're going to buy into index funds, you're looking into investing for, a 10-year kind of mark, okay? But as a whole, index funds are great. And like, I'm going to go through all of these 5. I'm not going to go through them in detail because, well, there's just too much information on them. I'm just giving you a brief introduction on each thing or the things that I believe are worth investing in. But please go out and do your research. Now, number 2 on the list that we're going to talk about is stocks. Well, individual stocks, okay? Like Tesla, Google, Apple, right? That kind of thing. I believe index funds are generally better for the majority of people out there. Just again, like I said, it requires little to no work. You're buying a whole group of companies, or you're buying into, should I say, or investing into a whole group of companies. However, every now and then I do dabble in my individual stocks, especially if I see that the time is right, and the charts are looking good, and I believe that we're going to see some kind of pump over the, next 3 months, 6 months, a year, however it's going to go. Now, you're not looking at an index fund, which is a group of companies. You're looking at a very individual company, and you've got to have reason to believe that this company is going to do well for whatever reason. So there is a bit of research that is required into investing into individual stocks. However, along with that, it does come with greater reward. Just be careful though, you can lose money long term, especially if you're not keeping up to date with it all and then being a little bit more on top of things, because, well, you're putting your money into a company and your investment is dependent on that particular business doing well. Now, there are lots of free stock trading platforms out there that, I can recommend. I do have my link down below to my Direct Me page, which I believe I've got a couple of trading platforms on there. You do have to be careful as to which ones are available to US residents or not. And you can get free stocks if you click those links, if you so choose to. Okay, they're just apps that I use or have used in the past and have worked great for me. And when you do that, and when you do buy your stock, your individual stock, whatever it is, and you do well, and with just that little bit of luck, you could end up making a lot of money. Now, when it comes to the cons, it does take a little bit more time, a little bit more research, and is a bit more riskier than index funds. However, again, to avoid being a broken record, a lot more rewardable if done right. Now, number 3, real estate. Now, this one is whole other kettle of fish, and I'm going to try and break it down as briefly as I can. And I am going to be doing individual videos, as I said, on all these 5 things, and also doing podcasts and bringing in actual experts of the fields, because I, by all means, am no expert. However, like I said, these are things that I have done or I'm doing currently, and just putting my own spin on it. So real estate is a great way to invest. Okay, it's a great way to invest. Again, just like with everything, if done right, but can be very, very, very lucrative. Of course, investing into real estate is far more time consuming, far more intricate than, let's say, investing in some index funds and sitting back and doing nothing. But the returns are so much higher. And, there's different ways of real estate. You can buy houses to refurbish them and sell them, flip them, or you can buy so you can rent them out later on. A great kind of little sequence that you can do is, 1, buy a house that is undervalued, right? Goes without saying. Number 2, buy in an area that over the next 10 years is going to increase in value. Number 3, get a fixed rate, low interest loan for about 30 years. Number 4, renovate and fix up that property. Number 5, rent out that property, and that rent should cover all of your expenses and leave you more in the pocket. And 6, well, repeat it over again. Now, the pros with real estate is very, very clear and evident. Okay, you've got price appreciation, you've got the rent that's going to be coming in every month. You can loan against each property. I mean, it gets deeper and deeper and deeper. The cons with real estate is, well, it's a lot of work, right? All the research, trying to find the right property, making sure that property has got, you're buying it at a good value, and the property prices in that area is going to grow over the next 10 years, all these little things. And another important con, which I have to mention, is, well, it's obvious, but you've got to be qualified, meaning you've got to have the deposit for the property. You've got to be eligible to get that loan in the first place. And of course, you've got to have sufficient income to prove that, as well as being, of course, fairly illiquid as well while you're holding these assets. But after all of that, if you can qualify, if you know what you're doing, if you've got the time to spend to find that right property and to get on that property ladder, it's one of the things that I would thoroughly recommend. So, real estate, number 3, top notch. Now, number 4 on my list, cryptocurrency. Now, cryptocurrency is something that I specialize in. I've been in cryptocurrency for the last 4 years. Not a hell of a lot of time in crypto, but it's been very, very lucrative for me. And it is something that I did do full time, or I can say I'm doing full time still. I love cryptocurrency. I love what it stands for. I'm not a maximalist. I'm not a big believer on Bitcoin is going to take over the world or whatever else, but I like to think I can see where the money is when it comes to crypto. And it's, again, I would say out of the 4, probably one of the easiest and hardest way to make money out of your investments. double-edged sword because, well, it's easy, because it's very easy to get started with crypto, and I will be doing a whole series on how to get started with crypto, where to buy, sell, trade, all this kind of stuff, and how to keep as safe as possible. It's very, very important. Too many stories I hear of people losing money from scams or sending the address to wrong places and everything. But it is incredibly easy to get started with crypto and to invest. You know, you can do very simple strategies like dollar cost averaging. Let's say $100 a month, every first of the month, or whatever it be. And of course, you know, there's a whole load of cryptocurrencies and what you invest in, and you know, that all comes down to your own due diligence and your own research. The hard thing about it is just that, you know, cryptocurrency is incredibly volatile. We've seen incredible swings, I mean, this year alone, and you've got to know how to hold your shit together, especially when you've got a lot of money involved. But it's all an emotive thing. The cons to cryptocurrency is, like I said, incredibly volatile, the most volatile out of everything on this list. But if it is something that you're going to focus on and concentrate on doing, then, well, you can make a lot of money, and you can make a lot of money very, very quickly. Again, if you want to know anything about cryptocurrency or where to buy, where to trade, all this kind of stuff, I do have links on my direct me link, which is down in the description below. So that's number 5 on the list, isn't it? 1, 2, 3, 4. Sorry, number 4 on my list. Number 5 on my list is investing in yourself. Okay, and I don't mean, you know, go and do online courses. You can, and it's great. You know, knowledge is a massive factor to everything, right? The more you learn, the more you know, the more confident you'll be in your certain field. So investing in yourself can, of course, yes, go out and you know, take courses in specific fields if you like, but it's not just about that. It's about reading, you know, about, you know, anything, letting your brain soak in information about business, about marketing, about selling, about philosophy, about health, keeping your mental mind engaged, and as well as your health. You know, go to the gym. If you're sitting down at a desk all day, every day, get your ass up, sign up to a gym and work out. You know, get that blood flowing, get your body and your brain working together in synergy, because I promise you, if you do that, you will be more than capable to take on all challenges that will come along the way when it comes to investing. You know, we'll be sitting down investing about different index funds, or you know, where to get real estate, or how to get your mortgage, or any of these kind of things, right? Definitely invest in yourself. Read books, do whatever it is you can. Also spend time networking, getting yourself out there. You can make a hell of a lot more money when you have the right people around you and helping you towards the goals that you need. If you've got people that are around you that are just, you know, sitting back and not caring about life and just happy with doing their 9 to 5, then that's great, but they're not going to give you very much encouragement to get out and better yourself and do better. So yeah, surround yourself with the right people. So those are the 5 things: index funds, individual stocks, real estate, cryptocurrency, and of course, investing in yourself. Now, the last point of this video, and I would say arguably is the most important point, or the most important question that I hear a lot from a lot of people, is how much should I invest? I make X amount a year. How much of that should I put into investing, into stocks or crypto or real estate or whatever? Well, I'll start off by saying it's a very, very difficult question to answer, all right? But you do have to be conservative, and you have to kind of have a plan and stick to it. Do know that whatever you invest and whatever money you're willing to invest with, be willing to lose it as well. You know, obviously no one wants to lose money, no one likes to lose money, and no one goes to invest with the idea and the scope that you will lose money. However, it's good to just know that in the back of your mind, because, you know, hey, the stock can just plummet down, or a cryptocurrency coin that you're holding could just halve in value, or even a property that you own that you're renting out isn't being rented out, it's just sitting there. So there's a lot of things to take into account there, but there is a general rule which, you know, I read about a long time ago, and I hear a lot of people talk about, and I think it's a good rule to kind of stick to, or to start off with anyway. And there's no hard or fast rule for everybody. You need to be fairly liquid with things and look at your own situation to see what you can afford. But it's the 50-30-20 rule. Now, first of all, when you're thinking about how much to invest, it may be tempting to look at how much you've got in the bank. But you should also think about how much money you will need. While it's not always a fun question to think about, ask yourself, what are my goals? What am I trying to accomplish? And with that information in mind, you can go to some tried and tested rules of thumb. That is going to help you get started. Many generally recommend setting aside 10 to 20% of your very important to note, after tax income for investing in, your stocks, your bonds, your investments. But do know that, there are different rules, in times of, let's say, inflation, which we'll cover in a completely different video. But your current financial situation may dictate a different plan. So what is that 50-30-20 rule? Remember, after tax income, okay? 50% needs, 30% wants, and 20% savings and paying off debts. That 20% threshold covers both savings for your short term, like your emergency funds, and for longer term goals like investing for a home or for after retirement. This type of budget also makes you think about other priorities. Once you decide on a plan for saving your 10, 15, 20%, which we're going to go into in a bit more detail in a second, it's definitely a good idea to automatically transfer that amount every month from your paycheck into a separate account that's just for your investments. Having this plan in place will help you avoid that temptation of, using that money for your short-term desires that you want. If it's already stashed away, just like you would do stashing away your money for your taxes, if you stash it away in a very separate account, and that's purely just for your investments, then you will not have the ability to touch it consciously anyway. Now, this 50-30-20 rule is a great way to kind of start, or at least to start your framework and figuring out how much you should be putting towards your investments. However, for some people, or for many people, especially people in their 20s, this amount might not be realistic. You might need to gradually work up to that 20%, right? You can start with a 5%, 10%, whatever it is. And it's okay to hold off from, maxing out the amount you can invest to focus on other short-term plans, such as your student loan. Finally, it's important to remember that your investing goals can and will change, right? You have to be fluid. You should always be doing an annual review at the very least of your plans, but you should also see at the end of the year, if you have any extra or spare money put aside to, put even more into your investment. And even if the dollar or euro amount or wherever you're from fluctuates in your investments, establishing your investing discipline early and then sticking with it, no matter what's happening in the market at the time, is valuable. There is that great saying, if you haven't heard it, I think it's very important to hear, especially for the first time. Time in the market is more important than timing the market. And your ideology and your methodology and your literal meaning of this will change throughout the years, okay, and or how you interpret it. But it's very, very important to know and to note. Now, before I wrap up this video, what was the most insightful part that helped you? Let me know in the comments below, as I'd love to know. For now, have a good one.